this question, what else can I invest in? So why is that the wrong way to think about your portfolio? That question assumes that more is better, but is it? Here's what 3 of the most acclaimed investors of our time had to say about adding more holdings to diversify a portfolio.
Diversification is for the know-nothing investor. It's not for the professional.
And there's nothing wrong with the know-nothing investor practicing it. It's exactly what they should practice. It's exactly what a good professional investor should not practice. But that's, there's no contradiction in that. A know-nothing investor will get decent results as long as they know they're a know-nothing investor, diversify as to time they purchase their equities and as to the equities they purchase. That's crazy for somebody that really knows what they're doing. You will find opportunities that if you put 20% of your net worth in it, you have wasted the opportunity of a lifetime, in terms of not really loading up. Charlie and I have been confident enough, if we were only running our own net worth, I'm certain a very significant number of times, if you go over 50 years, there have been a lot of times when you'd have put at least 75% of your net worth into an idea, aren't there, Charlie?
There have been times in my life when I've had more than 100% of my net worth invested in things.
That's because you had a friendly banker, and I didn't. I mean, you will see things that it would be a mistake if you're working with smaller sums. It would be a mistake not to have half your net worth. You're not going to see them often, and they're not going to be talking about them on television or anything of the sort. But there will be some extraordinary things happen in a lifetime where you can put 75% of your net worth or something like that in a given situation.
It's the way it's now taught. And some of these people write articles in the newspaper and other places, and they say, well, the whole secret of investment is diversification. That's the mantra. They've got it exactly back-assward. The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple.
I don't believe in diversification at all. I would own one stock if I could find one great stock. Diversification is a big mistake. I call it diversification. You buy this thing that might balance this other thing and they both go down. So I don't believe in diversification at all. I would own one stock. But what I do believe in is if I find 10 good stories, they're all equally attractive, I buy all 10 and I wait to see them unfold. It's like watching 10 poker games. 10 games of stud poker. You watch the cards turn over, story 3 gets better, story 6 slips, story 7 stays the same but it goes up 50%. So you sell 7 and buy 2. That's all I do. So if they're equally attractive, I buy all 10. Then gradually some story says, oh my God, this is getting better and better, and guess what? The stock just went down. So you keep watching 10 stories and magically, because of that rule of stocks going up and down a lot, then you load up. You really, take a big advantage. So that either happens because something happens to the company or the market goes down and all stocks go down.
Here's the problem. As I've discussed in several of my past videos, links in the pinned comments below, the more you diversify by spreading your assets all over the place, the worse your portfolio performance. If you take it too far, which by the way is the norm these days, then you'll get not only abysmal returns, but your returns over the long term won't improve much as you take more risk. What will change as you take more risk is that your maximum loss will get much worse, as you can see here. Little more return, but much more loss for taking more risk. That doesn't make any sense, does it? After watching these 2 videos with Warren Buffett, Charlie Munger, and Peter Lynch talking about how to create outstanding returns, I decided to model out some ideas just to try and see how they'd play out. Now I'm going to caution you, don't try this at home as Warren Buffett discussed, unless you're very comfortable with your ability to evaluate companies and pick likely winners over the long term. This is something that should only be done by a professional. For easy portfolios you can implement yourself, watch my video, The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, or The Ideal Portfolio Using Individual Equities. Links in the pinned comments below. Now let's get back to the high growth portfolio using just 4 stocks. I'm going to start with a no-brainer that you could have had in your portfolio, Apple. Now I know what you're going to say. Yeah, Calvin, you know Apple's been a stellar performer, so you're using future knowledge to show how great it was. Look, that's not the point of this video. There are two things I want to demonstrate here. One, diversifying into just a few high-growth potential stocks will give you a better portfolio than any one of those stocks, including Apple. And two, if you pick one or two duds and you don't really get the best high-growth stocks in your portfolio, the results will still likely be very good. So with that disclaimer and the setting of expectations, let's look at how one of the best performing stocks looked over the past 20 years. Yeah, you guessed it, Apple. But who would have been crazy enough to just put all of their money into Apple over the past 20 years? Now, some people probably did it, and they're very, very happy campers right now. But that's kind of a crazy thing to do. So what if we were to pick 4 stocks? Now, these are 4 stocks you could have easily picked 20 years ago and held over that entire period. Now, who would have been brilliant enough to pick Apple, Amazon, Google, and Microsoft? Probably nobody. But I'm showing you this not to say, oh, you should have picked these 4 stocks and held them for 20 years. Yeah, and if you did that, by the way, congratulations. But what I'm showing you here is if I pick Apple, Amazon, Google, and Microsoft and hold them over 20 years, my resultant portfolio has almost all of the return of Apple, and it only has less than half of the maximum loss. So I'm getting almost all of the return and about half of the maximum loss. That is a really good benefit, and one that most people wouldn't think about. So now let's throw out the 2 best performing stocks in the group, Apple and Amazon, and let's replace them with Intel and IBM. So as you can see from the bubble chart, these 2 investments really lagged the performance of the S&P 500 and the NASDAQ 100 for that matter. And yet the portfolio performed better than the S&P 500 with much better maximum loss characteristics. I mean, an almost 20% compound annual rate of return with only a 40% maximum loss, that is a really good result. So here's the real kicker. If you're very risk averse, you can moderate the risk without totally killing the return by adding a healthy portion of consumer staples stocks, as you see here. So what I've done is I've added 50% of the ETF XLP, which invests in consumer staple stocks. And you can see that the overall portfolio still has a very healthy compound annual rate of return over 20 years, but the maximum loss is less than half of that loss of the S&P 500, which was 55%. This is a really good portfolio. Oh, so you want even less risk? Then use the pyramid structure I discuss in the ideal portfolio videos, where we use 20-year treasuries as a protective base. You can see those here. And then we use consumer staple stocks, as you see here, as the stable growth portion of the portfolio, and then our 4 high growth stocks as in the high growth portion. You can see that even without the 2 best performing stocks, Apple and Amazon, the overall performance of this portfolio would have been stellar. I mean, a 12% compound annual rate of return over 20 years with less than a third of the maximum loss of the S&P 500, which, by the way, had a 55% maximum loss. This is magnificent. And look, I'm not saying you're going to get this performance going forward. You have to get this part at least somewhat right. And that's hard. That's a lot of work, and it's hard to do. So I don't recommend you try this trick at home. Look, my point is this. A competent money manager will be able to select a small number of stocks that are likely to outperform over the long term. And hey, look, if they don't get it 100% right, you pick IBM and Intel, they end up not doing that well. You replace them with something later, like Amazon or NVIDIA or Netflix or any number of high flyers that you could have picked over this past 20 years to replace these 2 stocks. At Clear Capital Management, we use our proprietary natural selection algorithms to identify likely candidates, and then the real work begins to determine if they're fly-by-night or they have real staying power. Our current top holdings include the likes of Tesla, Palantir, Nvidia, Microsoft, and Coinbase. And look, I don't expect all of these stocks to deliver over the next 10 or 20 years. And as that becomes more obvious, we'll replace the laggards with other strong, high-growth companies that show more promise, as Peter Lynch discussed in his video. Do you currently have a large position in a single company that you currently work at or you worked at in the past, and as a result you have a large number of restricted stock units or RSUs? If so, use the email link in the pinned comments below, and let's talk about some ideas for how to put some protection around them without muting your upside returns. Normally at this point in my videos, I would go through the current state of the stock, bond, gold, and crypto markets. But going forward, I'm going to provide that analysis to those who use the link in the pinned comments below to email me and request access to my weekly market updates. What I will tell you is that the markets appear to be struggling because of the uncertainty still ahead with the new administration in Washington, and that's reflected in the metrics I normally present in my weekly updates. And if you reach out, I'm also happy to answer any questions you have. So please click on the link, send me your thoughts and requests in an email, and let's talk. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.